Hey guys, so in this video, I'm going over my top 7 stocks for the month of May 2021. I spent the last month sorting through hundreds of different companies, and this is my list of stocks I think are the best buys right now. Be sure to watch all the way through to get my full analysis on each of these companies. I'll be going over the key numbers, the recent news, and why I expect them to grow and make you money. Huge shout out to Policy Genius for sponsoring this video. So let's get started. The first stock on my list is CONTEXTLOGIC Inc., stock ticker WISH. This is an American online mobile e-commerce platform, also known as Wish.com, that connects buyers directly to factory sellers so that online consumers can easily shop for affordable products, whether it be clothing, electronics, gadgets, or more. Right now, CONTEXTLOGIC Inc. is trading at $15.12 with a 52-week low of $11.71 and a 52-week high of $32.85. So really, you can see just how low the current price is compared to the 52-week high. If we take a look at the 1-year price chart, we can see that this company grew significantly at the start of 2021, but starting in February, they took a really big hit, and right now they are trading relatively close to their 52-week low. CONTEXTLOGIC has a market cap of $9.344 billion, no PE ratio since they are not yet profitable, with an earnings per share of negative $5.87. If we take a look at their valuation measures, we can see that their price to sales ratio is 0.68, and they have a price to book ratio of 8.15. As far as their profitability, they are not too good, with a profit margin of negative 29.32%, and the return on equity, which you get by dividing the net income by the shareholders' equity, which basically is a measure of financial performance, is negative 132.56%, which is very low. But right now, all these numbers are negative because they are not yet profitable. In the last 12 months, they've had revenues of $2.54 billion with a gross profit of $1.59 billion. And looking at their balance sheet, we can see that they right now have total cash of $2.13 billion and a current ratio of 1.74, meaning they have 1.74 times the current assets as current liabilities. I always like to see the current ratio above 1 because that just shows that the balance sheet is a little bit less risky. Now, it's always interesting to see what the analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, they are rating CONTEXTLOGIC as a 1.9, meaning it is a buy. And the average analyst price target is a whopping $26.36, which is almost 2 times as high as the current price of $15.12. As of right now, Wish.com has over 100 million average monthly users, with its business based in over 100 countries and 500,000 partner merchants to manufacture, advertise, and sell products on their platform. They're specifically trying to thrive in an online mobile e-commerce market, and as the e-commerce market is expected to approximately double from $3.4 trillion to $6.3 trillion by the year 2024, the percentage of mobile users within this market is also expected to increase substantially. And with its most recent quarter earnings reported being Q4 of fiscal year 2020, Wish experienced a 38% year-over-year growth in its total revenue, and this growth should only be the beginning. And then speaking of earnings, they recently announced that they would report earnings for Q1 fiscal year 2021 on May 12th. So definitely look out for this date because I do think that this is going to be a pretty great catalyst for a stock that is quite likely to be trading at a discount right now. Wish also recently announced that it had formed a strategic partnership with the South Africa Post Office to optimize logistic capabilities for its South African consumer market. It's really impressive how a company that has just IPO'd last year has already secured a crucial international expansion deal. And above all, they have a really positive mission, I believe, and that is to connect more and more consumers with really affordable products, which is more looking to appeal to a broader market of consumers who may not be able to afford brand name consumables. The company reports that the median annual household income of a Wish buyer is $50,000, with 75% of the company's buyers having an annual household income of under $75K. And with solid prospects of an expanding market and solid evidence of an expanding business within the coming years, I think that CONTEXTLOGIC, aka Wish, could be a pretty great bet to invest your money. And that is why I will be adding it to my portfolio. Okay, so the next stock on my list is FIVERR, stock ticker FVRR. This is an Israel-based global online marketplace where users can sell or purchase freelance services. I know a lot of people that are actually on this platform as a freelancer, and really I do think that the market is growing a lot for this company. So right now, FIVERR is trading at $224.25 with a 52-week low of $36.91 and a 52-week high of $336. So yeah, you can see just how much it's increased in the last year, but right now it is quite far from its 52-week high. If we take a look at the 1-year price chart, we can see that 1 year ago they were trading under $50, and since then it's seen almost a linear growth all the way up to over $300, and after that there was a pretty big correction down to where it is today. FIVERR has a market cap of just over $8 billion. They don't have a PE ratio because they are not yet profitable, with an earnings per share of negative $2.29. Their price to sales ratio ratio is 37.4 and their price to book ratio is 22.75. Now coming back to their profitability, like I said before, they are not yet profitable and they have a profit margin of negative 7.82%. The return on equity is sitting at negative 5.99%. And then looking at their balance sheet, we can see that they have total cash of $487.4 million with a very good current ratio of 4.05. And then as far as what analysts are saying, right now they are rating FIVERR as a 2.1, meaning it is a buy. And the average analyst price target is $299.75, which is 30% higher than the current price of $224.25. So in an expanding global market that is increasingly becoming digitalized, FIVERR makes sense as one of the next big service as a product marketplaces where more and more people can possibly leave their 9-to-5 jobs and start earning money by selling and performing freelance services over the internet. There still seems to be a lot of room to grow as FIVERR, which is an $8 billion company, is getting prepared to tackle a $115 billion market where the majority of freelancing still happens offline. There's also a lot of evidence of growth for FIVERR as the company reported a 77% year-over-year growth and a fiscal year 2020 revenue of $190 million. And while FIVERR still faces tough competitors like Upwork, the Israel-based company recently acquired another smaller freelance creative network called Working Not Working, and this indicates that it has the plans and the means to further expand and more deeply penetrate the market. As a marketplace, FIVERR continues to see growth in the number of buyers using its platform from 2.4 million active buyers in 2019 all the way to 3.4 million active buyers in 2020. That, you guys, is an absolutely crazy jump, and these buyers are continuing to spend more and more money each year. As a result of the extraordinary growth, many sources including Needham have listed FIVERR as a buy stock, and considering the fact that FIVERR continues to grow its business within a market that itself is growing and becoming more digitalized, I do think that FIVERR appears to be a really great stock to invest your money in, especially when it's for the long run. So yeah, definitely check out FIVERR if you have not yet done so. And now a quick word from our sponsor, Policy Genius. Policy Genius is America's leading online insurance marketplace. It's literally a one-stop shop where you can compare quotes from multiple insurance companies, which can save you both money and time, which means you can spend that time researching stocks and making more money. Plus, they don't add any extra fees for their service. For example, Policy Genius makes it easy to compare home and auto insurance policies from top companies to see if you could be paying less for your existing coverage. And if you're looking for life insurance, you could save 50% or more by comparing quotes with Policy Genius. If you have family members depending on your income, then this may be a smart move. The earlier you get it, the lower your rate could be. And you could save $1,300 or more per year by comparing life insurance policies through Policy Genius. With Policy Genius, you'll be able to get personalized quotes in minutes and compare quotes from multiple companies. They handle everything from paperwork to scheduling, and it's all a free service for you. I'll put the link in the description, so definitely go check it out. And now back to the video. The next stock on my list is SONOS, stock ticker SONO. This is an American-based developer and manufacturer of next-gen audio tech, including wireless speakers and multi-room sound systems. Right now, SONOS is trading at $42.63 with a 52-week low of $8.56 and a 52-week high of $44.72. So yeah, we pretty much are at the 52-week high. Now, if we take a look at the one-year price chart, we can see that SONOS started at around $10 just 1 year ago. And since then, it's just seen really crazy growth. It has literally 4x'd in the last year. Now, looking at their market cap, we can see that right now it is $5.105 billion, and they have a PE ratio of 118.09. That, you guys, is pretty high, but a lot of these tech companies are quite overvalued right now. Looking at their valuation measures, we see a price to sales ratio of 3.31 and a price to book ratio of 9.7. And looking at their profitability, we see a profit margin of 2.94% and a pretty good return on equity of 9.44%. In the last 12 months, they hit revenues of $1.41 billion with a quarterly revenue growth year over year of 14.9%. Looking at their balance sheet, we see that they have total cash of $677.83 million and a great current ratio of 1.98. Now, analysts don't like SONOS that much right now, and they rate it as a 2.4, meaning it is between a buy and a hold. And I mean, I sort of agree. I do think that buying it right now could be a great long-term hold, but it would be possible to wait for potentially a dip, and that would of course lower your cost basis, making it an even better return on your investment. And the average analyst price target is $44.17, which is just a few percent higher than the current price of $42.63. SONOS is still a growing and developing company that is already appealing to and thriving in several markets with fierce competitors. For example, SONOS is developing developing speakers that rival the products of Bose, both in terms of price and quality. This audio equipment market also includes tech giants such as Apple, and yet SONOS is really reporting lavish growth. The company experienced a 15% growth on its revenues for Q1 fiscal year 2021. This is because SONOS has many plans of expanding and compounding its business. To begin with, SONOS has started to enter the smart speaker market, developing an ultra-portable smart speaker called Roam that is both next-gen and yet still very fair in price. The one concern that investors had with SONOS before is how it planned on generating revenue in consistent cycles, considering the fact that its inventory only includes speakers and tech that take lots of time and money to build, market, and sell. They addressed this and tackled this problem by developing SONOS Radio HD, which is a subscription-based radio and streaming service that provides access to ad-free music with high-definition audio quality. So yeah, this is another pretty consistent income stream for the company. And finally, SONOS recently announced that it was collaborating with IKEA to create furniture speakers that can be easily mounted on walls and match home decor called IKEA Symfonisk speakers. Not sure if I am pronouncing that right. This is yet another great money-making opportunity for SONOS, as it is now working with a well-established home decor company, which should bring its products to yet another market. So because of these reasons, I do think that SONOS is definitely a company that you should check out, with stocks that should be worth a lot more in the future. But this is one of those stocks that I think is a little bit overpriced right now. So potentially wait for a dip, and if that dip comes, then consider picking up some of the stock. The next stock on my list is Penske Automotive Group, stock ticker PAG. This is an international Michigan-based transportation services company that runs car dealerships and distributes automotive technologies throughout the world. Right now, Penske is trading at $88.45 with a 52-week low of $29.65 and a 52-week high of $90.57. Taking a look at their one-year price chart, we can see just how much the stock has grown from just over $30 per share 1 year ago to tripling in value today. PAG has a market cap of $7.148 billion, a PE ratio of 13.11, which compared to most stocks on this list is very low, and that could mean that it is undervalued, with an earnings per share of $6.74 and a dividend yield of 1.94%, meaning this is a mild dividend stock. We can see that they have a 5-year PEG ratio of 1.1, a price to sales ratio of 0.35, and a price to book ratio of 2.17. Their profitability sits at 2.66%, and they have a return equity of 17.76%, which is quite good. Right now, they are carrying total cash of $49.5 million, and they have a current ratio of 0.94. Right now, analysts are rating Penske as a 2.1, meaning it is a buy, and the average analyst price target is sitting at $87.83, which is just under the current price of $88.45. So Penske Automotive Group has consistently surpassed expectations for the past decade, beating the S&P 500 in the growth of its stock and outperforming analyst predictions. They last announced their earnings results in February with an earnings per share of $2.49, which surpassed the Zacks estimate by nearly 20%. Recently, Penske Automotive Group completed the acquisition of Kansas City Freightliner, which is a company that sells commercial trucks. This acquisition is projected to produce $450 million of annual revenue. And furthermore, PAG recently announced its rebranding of its used vehicle supercenters, which will now comprise the global brand CarShop. The CEO of Penske, Roger Penske, remarked that the goal was to expand CarShop from 17 locations to 40 and to increase revenue from $2.5 billion to $3 billion. Now, one thing to note is that Penske will be releasing its Q1 fiscal year 2021 earnings on April 28th, which is one day after I'm filming this video. So definitely keep an eye out for that. I do think that they are a fundamentally fair valued stock right now, and I also think that their growth prospects make it a really good opportunity for any type of long-term investor. I'd recommend putting the stock on your watch list and look out for more updates on its expansion in the near future, because I do think that it really has the means and capital to grow its business further and further. That's why I'll be adding them to my portfolio. The next stock we're talking about is WINNEBAGO, stock ticker WGO. This is an American, Iowa-based manufacturer of recreational vehicles. Right now, WINNEBAGO is trading at $83.02 with a 52-week low of $39.43 and a 52-week high of $87.53. If we take a look at their one-year price chart, we can see that it started 1 year ago at around $40, jumping quickly to around $70. Since then, they declined quite a bit until November, when they suddenly shot up all the way to where they are right now. WINNEBAGO has a market cap of $2.789 billion a PE ratio of 17.92, earnings per share of $4.63, and a very small dividend of 0.58%. They have a 5-year expected PEG ratio of 0.56, a price to sales ratio of 0.94, and a price to book ratio of 2.76. This company has a profit margin of 5.65% with a very good return on equity of 17.96%. Looking at their balance sheet, we see they have total cash of $333.02 million and a strong current ratio of 2.69. Right now, analysts are rating Winnebago as a 1.5, meaning it is between a buy and a strong buy, and the average analyst price target is $86.36, which is a few percent higher than the current price of $83.02. So it's interesting because while Winnebago has garnered a solid reputation as a manufacturer of motor homes, it has recently ventured into the market of motorboat production and distribution following its acquisition of Chris-Craft Corporation in 2018. They recently held an earnings call in March to report its Q2 2021 quarterly earnings, and they reported a record quarterly revenue of $840 million and a gaining market share in the RV market. Specifically, the company estimates a 13% RV market share for fiscal year 2021 so far, which surpasses last year's market share of 11.3% and 2019's market share of 9.5%. So you really do see that it is growing. Also, Winnebago has developed and announced new products to be sold within the next few quarters, whether it be new motorhome segments like the Winnebago Journey or new motorboats associated with its Chris-Craft acquisition like the Calypso 35 or Calypso 24 motorboats. I do think that it's pretty safe to say that with its new inventory, Winnebago's potential revenue streams won't dwindle anytime soon. With the vaccine rollout and really diminishing COVID cases and the pandemic seemingly slowing down, it will be interesting to see how many people spend their money on travel within the coming months or years. I do think that this could be a pretty strong catalyst for growth for the stock. So yeah, definitely keep an eye out on this company because they might experience a massive boom in its revenue very soon. And yeah, I really do think that RV travel is quite great and it really is a booming industry. So that is one big reason why I will be adding this stock to my portfolio. Okay, the next stock on my list is Visa, stock ticker V. This is a California-based financial services company that specializes in electronic fund transactions, and it's widely known for its debit cards and credit cards. Right now, Visa is trading at $229.91 with a 52-week low of $170.38 and a 52-week high of $232.95. Looking at their 1-year price chart, we can see a pretty consistent upward trend in its price, with a few small corrections in the last year. Visa has a market cap of $506.917 billion, a PE ratio of 47.46, earnings per share of $4.84, and a small dividend yield of 0.56%. They have a 5-year expected PEG ratio of 1.94, a price to sales ratio of 23.7, and a price to book ratio of 14.46. They don't really have any physical products, so their profit margins are really good, sitting at 49.91%. And they also have a very sky-high return on equity of 29.39%. Right now, their balance sheet shows total cash of $18.04 billion and a current ratio of 2.12. Analysts do like Visa as a company, and they are rating it as a 1.8, meaning it is a buy. And the average analyst price target is $250.84, which is about 8% higher than the current price of $229.91. So we already know that Visa is one of the most valuable, well-established companies out there, and yet it still continues to scale its business and compound its great reputation. Quite recently, Visa announced that they would announce a global commitment to reach net zero emissions by the year 2040. This pledge will definitely benefit the company's publicity and market sentiment, as we see the market as a whole trend towards cleaner energy. More specifically, with the global pandemic, Visa still has been able to ensure contactless electronic transactions can be executed, and the numbers speak for themselves as the company reports that it has processed 1 billion additional touch-free Visa payments. Visa is also one of the few payment companies that is currently interested in moving into cryptocurrency payments, and it's reported to have launched a program to test cryptocurrency transactions through the Ethereum network. So given all the remarkable hype and excitement surrounding cryptocurrencies alone, I do think that Visa's prospects on buying into this whole crypto craze, appealing to the masses, and taking another step forward in the future of decentralized currency should yield massive benefits for its business. The most recent Visa earnings were released for Q2 fiscal year 2021, and some of the most crucial announcements that the company made was that the net revenues have remained largely the same, which does indicate that for Visa, its business is as usual, which is a good thing. And when we compare the data from this past quarter to Q2 of 2019, we can see that the volume of payments and processed transactions has increased by 16%. So yeah, throughout the years, and especially recently, Visa has performed very well, and they are still continuing continuing to grow steadily. So if you are looking for a more safe and more consistent, reliable stock in which to invest your money, I do think that Visa is a great pick for you. Okay, the last stock on my list is Amazon, stock ticker AMZN. Amazon, you guys have all heard of it, is a Seattle-based e-commerce company that's also branched into business in tech development, cloud computing, digital streaming of media, and artificial intelligence. Right now, they are trading at $3,417.43, with a 52-week low of $2,256.38 and a 52-week high of $3,552.25. Don't let the high price scare you. You can actually invest in partial shares, so you don't need to buy one full share of Amazon. Obviously, Amazon has been doing extremely well, and if we look at the 1-year price chart, we can see that 1 year ago, they were under $2,500. And starting in June of last year, they really shot up in price. Since then, they have remained relatively consistent between $3,000 and $3,500. Amazon is a gigantic company with a market cap of $1.734 trillion. They have a PE ratio of 81.7, an earnings per share of $41.83, and they currently do not pay a dividend. Their 5-year expected PEG ratio is 1.53. They have a price to sales ratio of 4.41 and a price to book ratio of 18.03. As far as their profit margin, it's sitting at 5.53%, and they have a very great return on equity of 27.44%. Amazon is sitting on $84.4 billion of cash, and they have a current ratio of 1.05. Analysts are rating Amazon as a 1.7, meaning it is a buy, and the average analyst price target is $3,993.18, which is close to 15% higher than the current price of $3,417.43. So it isn't news anymore that Amazon is the king of e-commerce. And despite how massive they've gotten, they have not run out of ways to bring profits to its shareholders. Recently, there have been rumors that Amazon might execute a stock split to lower its share price, which isn't at all laughable considering the fact that, like I said before, one share of Amazon is now worth over $3,000. As a result, this speculation has sent the stock price of Amazon higher and higher within the past week. What's so reliable about Amazon is that it has established itself as a multinational corporation that has many remarkably lucrative streams of income, such as Prime subscriptions, Amazon Web Services, advertising, and a lot more. Currently, Amazon has over 200 million Prime subscribers, and membership growth has increased steadily from around 25 million US users in 2013 to 150 million US users in 2021. And meanwhile, Amazon Web Services, AWS, which is Amazon's cloud computing service for businesses, continues to experience large growth in net sales and operating income. And they've reported a 28% year-over-year increase in net sales and a 37% year-over-year increase in operating income by the end of fiscal year 2020. One thing to note is that Amazon will be reporting its earnings on April 29th. So if you're watching this video past that date, definitely go check out their earnings. So if you combine the speculation of the upcoming Amazon stock split, as well as the durability of Amazon's business model and all its other really lucrative revenue streams, that gives us a stock that I think will continue to grow and bring profits to shareholders for a long time. There really is no wrong time to buy Amazon, and if you dollar cost average the stock for the next 20-30 years, I do think that is going to be a very reliable investment. So yeah, those are my top stock picks for the month of May 2021. Also, if you guys don't know what any of these metrics mean, I'll link my how to invest in stocks video below, so you guys can check that out if you want to learn how I actually analyze stocks and what all these different things actually mean. I always tell you guys this, but you need to do your own due diligence before investing in any type of stock or investment, period. Just because the stock is on this video does not mean that you should just go out there and buy it. I'd say dedicate at least 1 hour to research each stock you're interested in, and then proceed to make your own decisions about whether or not you want to invest in it. If you guys have not yet started to invest, but you are interested in getting started, I will put some links below if you want to get some free stocks for opening up an account. WeBull is giving out 2 free stocks right now, and Robinhood is giving out 1 free stock. And lastly, I'm not a financial advisor, so take this video as entertainment purposes only. Happy trading, you guys, and if you guys enjoyed the video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.